webinar. Behavioural Finance, what do I need to know and how can I use it, which will be presented by Simon Russell from Behavioural Finance Australia. I'm sorry, I've got a neighbour's dog here with me who's just crying, so if there's some extra noises, forgive me. It's the lab, not me. Following the presentation, we're going to open the forum up to questions, but if you've got any questions along the way, please, by all means, type them in as you think of them. I'm going to hold all those questions to the end, but I would recommend just type your questions in as they occur to you, and then Simon will answer them at the end of the presentation. Just use the Q&A function at the bottom of your screen. We're also going to get you to do a short quiz to consolidate your learning outcomes for CPD accreditation, and to receive CPD, you do need to attend the entire webinar. But now, of course, it's my great pleasure to introduce Simon Russell. And Simon is the founder and director of Behavioural Finance Australia, which delivers specialist behavioural finance training and consulting to financial services professionals. Simon has qualifications in psychology, finance and financial planning, and is the author of 3 books on behavioural finance. They're excellent books. I really recommend them to you. So we're delighted to welcome Simon today to deliver the webinar. And Simon, over to you.
Thanks very much, Silvana, and welcome everybody. So yeah, today's topic, behavioural finance. What do I need to know and how can I use it? So just to give you a brief overview, what do I need to know? I'm going to really focus on, well, what's coming down the track at advisors, stockbrokers and sort of product providers from a regulatory perspective. How does behavioural finance fit into some of the things going on in that area? And then how can I use it? So that's going to be most of the focus is going to be on that. Sort of practically, how can you use it to get better client engagement, to sort of improve different aspects of your advice business, the way you talk to clients, for example. So if you like, there's a bit of a carrot and a stick here. The stick is the regulatory sort of burden that behavioural finance is sort of being embedded into, and the carrot is then all the good stuff that hopefully can be sort of practically useful for advisors, for brokers and others in the industry. And along the way as well, I'm hoping to sort of bust a couple of myths about behavioural finance that I sort of see around the traps. Anyway, without further ado, let's jump in, and we'll start with the stick. So what's happening from a regulatory perspective, and what's the journey, I guess, we're on, and therefore what can we expect down the track? Well, broadly, if you look at this regulatory journey, sort of with a behavioural finance lens, we're moving from a rational to a behavioural view. So where have we come from and where are we going? Well, we've started off with a view that people are rational, clients are rational. So what we need to do if we want to make them or help them to make good choices to achieve good outcomes is that we just need to tell them stuff. So if we give them a lot of information, tell them all the things that they should need to know, then they should listen to what we have to say. They should read the documents we give them. They should understand, digest all that information, assimilate it, analyze it, assess it, make sure it's sort of fit for purpose and in line with their own best interests, and make good decisions. So really what we need is a whole lot of disclosure. And so what we need is the statements of advice, and we need PDSs, and we need FDSs, we need FSGs, we need all these disclosure documents, and maybe we need a bunch of warnings. So if someone's maybe in danger of making a bad choice, well, we just give them a warning. It's a general advice warning, or a limited information warning, or a past performance is not a good guide to the future warning. We give them all these information, give them all these warnings, and they should make sound financial choices. So that's sort of where we started at, and that aligns with, I guess, broadly where behavioural finance, or in the absence of behavioural finance, before behavioural finance came along, the view that, well, actually people make these sort of rational choices. And so really we just need to give them a whole lot of disclosure. Now, you might well say, well, it doesn't seem like we've moved on a lot from that, because we do still have all those documents. We still have SOAs and FDSs and all the like. And on that measure, I would say, yes, I agree. However, the balls are definitely in motion, or the wheels are in motion, and the wheels have been in motion for a few years now. So if we say, well, what's happened from this sort of initial starting position? Well, we had the financial system inquiry. This is the Murray review in 2014. which actually laid a bit of the groundwork for what was to come. So back in that inquiry, they did envisage, for example, having some behavioural finance related education requirements that would be imposed on advisors, which ultimately we've seen as part of the FASEA sort of round of education requirements and reforms over the last few years. And if you look at that financial system inquiry document, it had, I think, 20 references to behavioural biases. So we're starting to say, actually, we can't rely on people making these fully rational decisions. We need to incorporate some insights about how people actually make decisions in the real world. Then, of course, a few years later, we had the Royal Commission. There's a lot in the Royal Commission, obviously, which I'm not intending to reinterrogate here. But from a behavioural perspective, one thing that maybe some people overlooked as part of that process was that that Hayne, in that case, commissioned a report which was written by Professor Sunita Shah from, I think, Cornell University in the US, which specifically looked at decision-making issues, behavioural bias issues, focusing mostly on conflicts of interest in this case. And it wasn't the only driver, of course, of some of the recommendations that came out of the Royal Commission, but it certainly was one key input into some of those recommendations. And also importantly, that report that Sunita Shah wrote addressed decision-making biases, not just from a client perspective, but actually broadened it out and said, well, how do these things actually impact advisors as well? So if an advisor does have a conflict of interest, how might it impact their behaviors? Might it act on them beyond their conscious awareness, for example? And what are some of the strategies that we can employ, not just for clients, because we know clients aren't necessarily going to read disclosure documents, for example, but also for advisors. So the evolution has sort of continued from there. Then later in 2019, ASIC admitted defeat on disclosure. So what do I mean by that? Well, they issued a document called Disclosure, Why It Shouldn't Be the Default, which I think from memory, they co-authored with the Dutch regulator. And in it, they said, it's time to call time on disclosure as the default consumer protection. It's not the silver bullet once thought, nor should it be relied on as one. So their document then outlined a whole lot of research, not just from Australia, but globally, showing that what happens when you give people information, that you disclose various types of information about the products and services that you might be providing, the financial choices they have. Well, actually, they often ignore that information, or they misinterpret it or misunderstand it, or anyway, a whole bunch of things happen that says actually telling people a whole lot of stuff is a pretty ineffective way to help them make good financial choices. So we can't use disclosure as the main tool anymore, according to ASIC. And then from 2019 onwards, we've also then had DDO, the Design and Distribution Obligations, and PIP, the Product Intervention Powers, the associated powers that gives some ASIC powers to enforce the DDO obligations. Now, these obligations, I should say, are not directly relevant or not directly imposed upon advisors, although they do impact advisors and brokers, perhaps indirectly. They are imposed more directly on the product providers themselves. So whoever's a super fund or an asset manager, for example, a platform provider, the obligations are imposed on them. There are some connections with advice, but it's more about the product and how those products are then positioned or displayed for people who may or may not be receiving advice. And so how does behavioral finance fit into that? Well, it fits in because if you look at the regulatory guide and says, well, what are the obligations on product providers? Well, they have to identify a target market for their products, and they have to take reasonable steps to make sure those products are then distributed to those target markets. And what are those reasonable steps? Well, they include things like being sensitive to what's called the choice architecture. The choice architecture is not the information about the products themselves, not the disclosure, but how the choices that people are given are framed. Like how many choices are on a page, or which choices on the left-hand side, or how are comparisons made. So again, less about the rational decision-making and more about some of those sort of behavioral things that can also influence people's choices as well. And then finally, near and dear to everyone's heart, we had the FASEA reforms as well from 2019 onwards. And those FASEA reforms actually have picked up a bunch of these sort of behavioural considerations that are directly relevant for licensed advisors. So, for example, behavioural finance is a significant component to, or has been a significant component to the advisor exam. From memory, it's sort of around 20% of the content is related to behavioural finance or behavioural client engagement related type questions. It's in the FASEA Code of Ethics. So it's imposed in ways like, for example, saying that advisors need to take steps to mitigate their own biases, their own clients' biases. For example, it's insufficient just to disclose information. You need to take steps to make sure your client actually understands your advice and the information you provide, for example. And behavioural finance is in the education requirements. So it's one of the key bridging units that FASEA imposed as part of those reforms as well. So you can see, I guess there's been a progression over the years, but we're moving more and more towards behavioural finance being fairly integral to some of the reforms that have historically taken place, and no doubt probably some of the reforms that are likely to come further from here. Now, I should say, when I'm running this sort of session in a face-to-face environment, I often ask people how they found the behavioural finance questions in the exam. And I typically get a range of answers. Some people say, oh, you know, they're pretty straightforward. Maybe I've studied behavioural finance before, and so the questions were easy. Or maybe, all I had to do was reflect on my client experiences, and actually I could sort of work it out intuitively. But then I also get people who say, yeah, but I found them quite subjective, and well, there's 3 answers on there and any of them could have been correct, which I think is interesting, because I think that is perhaps evidence of one of the myths, which we're about to get into, the myths about behavioural finance that some people perhaps are burdened by, which is that we should be looking for a definitive right and wrong answer. And I just don't think you're going to get that from psychology. You're going to get trends. You're going to say, well, this type of approach works better than this type of approach, or approach A works for this type of client, but it doesn't work for this type of client, or it works in this situation, but it doesn't work in that situation. So it's useful in the sense that it can help us do the things that are more likely to work in more of the situations for more clients more of the time, but it's never going to give us this is the right answer and it will always work for every client all of the time. So I think that's possibly one of the myths that some of the people who have struggled with the exam perhaps were burdened by. Anyway, let's, on that note, I'll go into some of the other myths. Yeah, so I've co-opted a couple of fine gentlemen here from the Mythbusters program that you probably recognize. So we've got Adam Savage, this gentleman here, and who's this? Jamie Heineman on the right, our myth-busting colleagues. Now, I should say, when I say myth in this case, I'm possibly or probably referring to things that are not necessarily right or wrong, but things that are probably not as right or more wrong than many people across the industry anticipate. So let's just have a look and see what our Mythbusters have got in store for us. Okay, firstly, I already know everything about behavioural finance. So this isn't something that everybody, I don't suggest for a second that everybody thinks this, but certainly some people do know a hell of a lot about behavioural finance. I do come across people who have studied it at uni, they've done PhDs about it, they've written books about it. So certainly some people that is probably fairly true. However, if that is the case, why has FASEA identified it as something that many advisors do poorly at the exam? So when FASEA didn't give much feedback on the exam, but when they did sort of outline some of the things that advisors who failed the exam needed to improve on, and some of those behavioural and client engagement type questions were on that list. And I should say, from personal experience, I actually marked, I don't know how many thousand, but a lot of those exams. So I did get some experience of marking some of those behavioural questions. And yeah, certainly some advisors absolutely nailed them and clearly know what they're talking about, but some also did struggle. So there's a bit of a mix in there. And why does client engagement commonly diverge from the psychological evidence? So this one gets me more, I think, because if we know about this sort of stuff, and to be honest, some of the research around behavioural finance isn't necessarily that new. Some of it's been around for 10 or even 20 years. And I think some of it's fairly well understood and accepted. And yet still there's quite a few examples where across the industry, so not just advisors, but looking at super funds and asset managers and others as well, we are doing things that not only don't incorporate behavioral principles, but sometimes work completely counter to them. So to give you a couple of examples, so one of them, right, so one of the principles we know from decision-making research, from behavioral finance, from psychology, is that when people are making complex decisions or choices that they perceive as complex or difficult, then what do? Well, they try and find ways to make those choices and decisions easier. And one way is to look and see what other people are doing. Right, so we know this. We know, for example, that people have tried, if you want to get people to pay their taxes, you send them a little note saying, hey, did you know 90% of people, or 95 or whatever the number is, 95% of people pay their taxes on time. You still have $150 outstanding. How about you pay it, for example? And that's been assessed, it's been measured, and it tends to work. If you want people to reduce their energy bills or their energy consumption, you tell them that other people are already reducing their energy consumption, or other people use less energy than them, for example. What you don't want to do is tell them that other people are using more energy than them, because that's going to work in the wrong way. And in fact, you do see some examples of that. So signs that say, hey, a lot of people litter in this area, please pick up your rubbish. Right? There's a message there, please pick up your rubbish, but unfortunately it includes the everybody else's littering in this area. So we've included that sort of social influence. And unfortunately what that means is that more people end up littering. So if you put this in a sort of financial services, superannuation, investment sort of context and say, well, what are the examples that happen in our world? Well, for example, you look at one of my favorite examples is super funds that say things like, did you know many people have multiple superannuation accounts? It's not a good idea because you might be paying multiple sets of fees. You should consider consolidating your accounts. So there's a message in there saying this might be in your interest. So setting aside for a second whether they might be losing their insurance or actually saving on fees. Let's assume that the messaging is correct. But the messaging then, you should think about consolidating, actually then has this countervailing force embedded in that same message saying, but actually a whole lot of other people, they don't seem to worry about this. They've got multiple superannuation accounts. So that's one example. Another one is, and again, this is from a major super fund. Look, the market's fallen recently. There's been a bit of volatility. The market came down. What we saw was a bunch of people switch their investments to the cash option. That's a bad idea. It's really a long-term investment. You should probably stay fully invested. Same sort of thing. The messaging saying you should stay fully invested then has this offsetting of social influence saying actually a lot of other people seem to be switching to cash. And in that case, it's quite easy. It would have been quite easy to say, you know what, most people really are sticking to their existing investments. Yeah, sure, other people might have been switching to cash. But that'd be a small minority. Most people don't switch their investment options in super funds very frequently at all. In both an advisor and a superannuation context, insurance is another good example. Did you know most people don't have adequate insurance, but really you should think about topping up your life insurance, that sort of thing. It's actually, it's countering what we might otherwise try and be getting clients to do if insurance is in their best interest. Okay, so if we know about behavioral finance, we probably should be sort of starting to tweak those things in the right direction rather than influencing clients away from the things we're suggesting. What else? Behavioral finance is just about fear, greed, and market cycles. So is behavioral finance about fear, greed, and market cycles? Well, yes, it is. I definitely say that's part. How do clients respond to market cycles? Do they panic when things crash? Do they switch their investments? Do they try and sell out at the wrong time? I completely agree. However, that would be a relatively small piece of the overall pie. So what about risk profiling, goal setting, diversification, savings, and financial literacy? What about all those things? Does behavioral finance fit in to any of those? Well, I would argue yes, and quite heavily in each of those cases. So taking them in turn, risk profiling. Yes, there's a hell of a lot of behavioral finance and psychology in risk profiling. So for example, if I'm asking a client, what would you do if the market fell 20%? And the client says, oh, you know what, I'm a long-term investor, you know, I'll probably, yeah, I'd hold on to my investments. In fact, maybe I might actually think about investing more because I'd like to buy the dip. Okay, fine. And then what happens when the market falls? Well, actually, there's a narrative at the time about why it's falling. Well, there's a coronavirus and we're all shutting down. There's emotion because actually now I actually have the feeling of the emotion attached to having realized a loss. So there's quite a bit of psychology in the questions that we ask, how we interpret those responses, how able clients actually are to answer, not just understand, but to actually answer those questions because of the difficulty they have in this case, being able to predict their own future decision making in a context that they don't necessarily quite understand. So risk profiling is definitely a big one. Behavioral finance can influence. Goal setting, I think, is another one. So goal setting, there's a bunch of things like, should we have a defined goal? So I want to retire at the age of 65, for example, or a fuzzy goal. Should it be, oh, well, actually between 30 to 63 and 67 is fine, given how difficult it can be to predict what we're going to want to do in the future. But then which of those goals might be motivational? Is it the more concrete, specific one or the vague one? Or should we have, yes, okay, but fine, I want to retire at 65, but actually I need to have a savings goal, which is a weekly goal or a monthly goal? And to what extent do goals actually then align with things that make people happy? If my goal is to have a Lamborghini by the age of 40, and then when I get to 40, my goal is no longer to have a Lamborghini, but it's to have a 7-seater to put my 3 kids in the back. How well do my goals actually align with some of those sorts of more life-related events, but also the things that then subsequently have been found to make people happy and lead to life satisfaction. Diversification is another good one, which I'll touch on in a second, because how do we perceive diversification, the need for it, or the extent of it? Savings is another good one, because savings can be difficult, effortful. It requires vigilance. Should we be creating a budget? Yeah, maybe, but actually, do people then maintain a budget? Do they want to keep putting their items in a spreadsheet, for example, versus how can we make it easy to make the deductions automatic from their accounts, for example? How can we find savings and things that are perhaps overlooked? This is the whole idea that you might be willing to go from one shop to another if you're going to save $100 on a say a washing machine. All right, the washing machine's $1,000 at this shop, it's $900 at the other shop. Maybe you go to the other shop to save you $100. Would you do the same thing to save $100 on a $50,000 car? Well, maybe you wouldn't. A lot of people would say, when I've actually asked that question, a lot of people say, no, I wouldn't shop around to save $100 on a $50,000 car. But frankly, $100 that's saved, when you get to retirement, that $100 you find in your wallet, or the $200 it's grown to, it doesn't have a little marker on it that says this is the $100 you save on the washing machine, therefore it's important, and here's the other $100 you saved on the car. Actually, all those savings are equivalent. So there's quite a bit of psychology in the savings. And then financial literacy. So financial literacy, the common presumption is that if we can teach people things, right, if we can just teach people the things that they should be doing, that they'll do them. This goes back to that disclosure issue a bit as well. But typically it's either ignored, or it's misunderstood, or it just doesn't impact people's behavior. Traditionally, the way that we provide it, those things don't work. However, we can see the types of financial literacy that do work, which are little bite-sized pieces that are delivered just in time, right at the point that someone's going to make a decision, for example. So again, there's quite a bit of psychology in the financial literacy. And not just about emotions and fear and greed. What about attention, pattern recognition errors, motivated reasoning, and base rate neglect? So psychology has a whole lot of things in there, in addition to just emotion. So attention, for example, that market cycle that we're sort of fearing, we're getting greed as it goes up and fear as it goes down. Well, what if we were on a desert island during that period of time? What if there was no connection to the internet and we weren't aware of that market cycle? All right, we wouldn't be feeling any of those sorts of things, would we? And that is clearly because we wouldn't be paying attention to it. So attention really is mediating, in this case, the emotional responses. And I've got a couple of good examples about that. So I think that's a key one. How do we capture attention? What types of things capture attention? The pattern recognition errors are about how we perceive, well, the dips and extrapolate sort of trends into the future, how we perceive exponential relationships. Motivated reasoning is how we want to provide answers or want to think things that make us look and feel good. So this goes to the fact finding and risk profiling questions. And base rate neglect is, a base rate is like a statistical average, what normally happens on average. So this is a bit like we're all above average investors. All right, there's an average, which is that most people actually can't significantly beat a market, but no, we're an exception to that, for example. And there's a bunch of examples around base rate neglect as well. So if we're thinking about emotion, yes, I agree, it's part of the pie, but there's a whole lot of other stuff that we should be thinking of as well. A lot of psychology that can impact different types of financial decisions. And finally, it's just about my clients. So is behavioral finance about clients? Definitely it is. Is it just about clients? Definitely it's not. What about advisors, fund managers, and CEOs? So we're all human, I think, is the short answer here. Now, this is not to say that that we're all equal. So I'm not suggesting for a second that the decision-making issues and biases that might apply to an advisor are going to be the same or the same extent as clients. In fact, I've got a couple of examples where they're not coming up. However, there are going to be certain things that will apply to advisors. So one, for example, there was a large-scale study out of Canada which looked at how advisors appear to project their own risk profiles onto their clients. So what happened was they had, I forget what it was, I think thousands of advisors and I think hundreds of thousands of clients, and they could correlate the risk profiles and the investments of the clients back to the risk profiles and the investments of the advisor. Now, it wasn't just because high risk profile advisors were attracting high risk profile clients, because you could also see what happened when the advisor changed or when the clients moved to a different advisor or that sort of thing. So advisors in that case appear to be projecting their risk profile onto their clients. Fund managers, similarly, I mean, a chunk of the work that I do is with asset managers. So I would go in and talk to them about things like how they incorporate mean reversion into their earnings per share forecasts. Now, do the clients need to incorporate mean reversion into their earnings per share forecasts for the companies they're buying? I would guess not for many clients, simply because they're not producing earnings per share forecasts for some of those or many of those companies, right? But for asset managers, this is the key thing that they're doing, and this is where decision-making issues can emerge. They're also making decisions as groups, as teams, so there's a whole lot of decision-making issues that come from team dynamics. So it's just a different set of issues that apply to advisors, to fund managers, and also to CEOs, about how they allocate capital, when they make acquisitions, how they pay dividends. And finally, is it just about clients? Well, what about markets? And what about the interface between clients and advisors? So markets, we can look at how people pay attention to things, and we can see, yeah, sometimes it leads to overreaction. Sometimes it leads to underreaction. Sometimes it underpins things like a value effect or a quality effect or momentum, for example. A lot of this is underpinned by psychology. This is some of the things that I would often talk to asset managers about, saying, how can you use some of these concepts to better understand markets generally, but also specific investment opportunities? Well, how can you use this to identify the types of situations in which there's likely to have been an underreaction to a market event or an overreaction, for example? And then interestingly, I think the interface between clients and advisors. So this isn't necessarily a bias of a client or an advisor specifically, but it's the stuff that happens in between. So my favorite example there would be this thing called the illusion of transparency. So how that works is if I'm lying to you. So if I'm lying to you now, what would it feel like to me? Well, it would feel pretty uncomfortable. So it doesn't feel like I'm a good liar. I feel a bit of anxiety that you'd be on to me, for example. So it feels like, because that emotion is salient to me, it's obvious to me, I can feel it strongly inside. It sort of feels like it leaks out. It feels like you could probably tell that I'm lying. That's what it would feel like to me. Not just me, obviously, but when you put people in psychological studies, that's what it feels like. You ask them, do you think people are onto you, that they'll be able to assess whether you're actually lying? Yeah, it feels like that they probably can tell. And then how does it feel to you or to the person who's listening to this person who might be lying? Well, it sort of feels like that you could tell as well. Yeah, if someone was lying, I reckon I could see his eyes going up and to the left, or maybe he's scratching his nose a bit, or stammers and stutters a bit more than he normally does, or I don't know, wriggles around in his seat or something, right? It feels like there'll be those sorts of things. However, we'd both be wrong, all right? So what tends to happen is it's not as obvious. If I'm lying, it's not as obvious to you as it feels to me, and it's not as obvious to you as it feels like to you as well. So we both have this illusion of transparency. We're not as transparent as we think. Now, how that's relevant for advisors and clients is that if I'm a client, it feels like I don't need to really tell you more about what I'm thinking and feeling, because it feels like you should know. And if you're my advisor, it sort of feels to you like you know what I'm thinking and feeling as well. But actually, there's not as much transparency there as either of us think. So that's how I guess some of those disconnects can occur, and why you need to be often asking more questions than either you or the client feel is necessary, just because that gap is not perceived by either of us. Okay, so hopefully those things make sense, but feel free, as Savannah mentioned earlier, to put questions, comments in the chat function, and we'll get to them towards the end. But I thought what I might do for the rest of this session is to give you a few examples of how some of these sorts of principles, thinking broadly about behavioral finance and some of the sort of psychological issues about how clients read, understand, respond to information. So thinking particularly about sort of written forms of information here. What can we do to apply these sort of principles to improve how we communicate and engage with clients? Okay, so let me start with an example that I often get a bit of fun with from the face-to-face sessions, where, I don't know, if I have an audience of 100 people, I might give them a one-page summary, sort of a one-page questionnaire. So I might have a couple of questions on it. This will be the first of 2 questions. So what are 3 major super funds? Now, bearing in mind, this might be a room full of advisors, or sometimes it's a room full of super fund employees, for example. So this should be a relatively straightforward question. And sometimes someone pipes up and says, "Oh no, Simon, this question's easy. If you can't answer this question, you shouldn't be an advisor, or you shouldn't be working in a super fund, or whatever." And I would typically say, yeah, please, that's fine. Just write your answers down as best you think, as you feel fit, and keep your answers to yourself, and we'll just gather up the responses. So that's what we do. We gather up responses. Everyone sort of hands their papers to the front. And then when we've collected them all up, I say, okay, so for this first question, what do you think? Do you think most people would have given 3 major super funds for that? Or would you say that maybe they've given 2 or 1 or 0? Or what do you think? And normally someone will pipe up and say, oh, 3, definitely everybody, 100% of people will give 3 major super funds. Okay, fine. And then someone else will pipe up and say, oh no, I think maybe 70% of people will give 3 funds and 30% of people will give no funds. And the first person thinking, holy smoke, how possibly could 30% of people not be able to give any funds at all? And someone else says, oh no, I think 50% of people will give 3 funds and 50% will give no funds. Right? So there's a bit of confusion, a bit of disparity in the room. And so to work out what's going on, I then go, okay, let's have a bit of a closer look at that questionnaire that I've just asked everyone to complete. Now, what I haven't given you yet, but what everybody would have had, because on the piece of paper straight in front of them, in fact, at the top of the piece of paper, right immediately before this first question, is this important information. So there's a few words on the page here, but it's worthwhile me just quickly going through these words. So it says, collection of survey information can be an effective way to gather empirical evidence into people's decision-making. Surveys can sometimes show results that do not accord with our initial expectations, thereby creating an opportunity to learn more about how the human mind works and to find ways to apply that knowledge to benefit individuals who are likely to make similar decisions in a real-world context. Survey design is an important consideration because often people do not pay attention to relevant information. When they ignore relevant information, they can make mistakes that, were they aware of the relevant information, those mistakes would not have been made, mistakes that can create real economic costs for individuals, industries, and countries. To test whether you are still paying attention, please ignore the first question below and skip straight to the second question. The results of this survey will therefore provide an indication of survey participants' willingness and ability to pay attention to relevant information. Okay, so clearly I have set people up for failure here by giving them all those words and embedding the key phrase in the middle of it. But why have I done that? Well, I've done that, I guess, as a demonstration of how people can be impacted by information overload. Now, bear in mind here, I haven't given them a 60-page statement of advice. I've given them 1 paragraph. And yet that 1 paragraph has been sufficient so that about half of people who I give this exercise to will not read that paragraph. They will then skip straight to the first question, and they'll do that. They'll complete that question. Now, bearing in mind these are advisors or super fund employees, for example, but I have run a similar exercise with retail investors. I did this through Livewire, which is a technology platform for self-directed investors. And for them, the first question I asked them was, how would you rate your attention to detail? So they had the important information. How many people read that important information? Only about a quarter of people did. So the 3/4 of people who didn't read that information went on to answer the first question. And the first question was, how would you rate your attention to detail? So their attention to detail clearly was not that great. But they then went on and rated it. Oh yeah, either very good or good. 3/4 of them said either very good, I always pay attention to information, or very good or good, or I usually pay attention to this sort of information. Okay, so this is an example where it's impacting advisors probably to a lesser extent than individual clients. The clients are more impacted in this case, but it's impacting both. In fact, I had one advisor who piped up and said, Simon, you can't expect me to read the important information. So part of what's going on here is that important information seems to be causing a bit of a distraction. And I've deliberately done it that way, I guess, because what we know from the psychology is that when you give people information overload, you give them too much stuff, give them all this text that's quite boring. It's got long-winded, wordy sentences in it. Not only do they not read it, but they look for decision-making shortcuts or heuristics. And one of those shortcuts, I think, certainly this would apply to me, and I think it applies to a lot of other people, is that when I see important information, I'm thinking, this is not really important information for me. This is important information for the legal team that created this. This is probably some type of legal disclaimer. This is not important for me to actually have to read myself. All right, so we should be thinking about what are those mental shortcuts and decision-making shortcuts, because sometimes actually it can have a complete 180-degree effect. The words on the page say important information. How I'm reading that as a client is not important, unimportant information. So I'll give you some examples of that coming up, but just in terms of what you could have done to this. So some of the strategies here, I think, are fairly well understood. So if I ask people what they should have done in this sort of case, if you really wanted people to skip the first question, what could we have done? And they normally come up with some pretty good suggestions. Could have put it in the title. I think this is a very good one. Putting things early on in titles means that they're most likely to get noticed. We could have underlined that, also using a bit of color in here as well. I reckon if that was underlined, people would have possibly or probably would have seen it. We could have deleted a whole lot of that stuff that really wasn't that relevant. And one of my favorite ones, I guess, is that we could have, big red danger sign, for example, that's actually you're gonna be missing something in this case. Now, deleting information, I think, is a fairly good solution to this. Although in practice, I do understand that it's difficult to be able to delete content from a template SOA, for example. So some of this sort of stuff has to go back to whoever's creating these templates and sitting down with the compliance and the legal team with some of these behavioral concepts and saying, well, how can we actually improve the document or the template itself? Which I understand it's going to be difficult for an individual advisor who's using those documents. But certainly that's something that licensee groups or the sort of compliance groups and similarly super funds can definitely help with. But it sort of also goes against the grain because there's a presumption that giving people more information actually helps them. They can sort of ignore it. If they didn't really need it, they could ignore that information. So it seems like it's harmless, but actually it's not harmless. It means that we're missing out on the most important information and we're not absorbing that. Anyway, so just a quick example, but I think with sort of broad implications. All right, here's another example. So I've just captured this page from from a pension fund in the US. And my question to you would be, what do you think is the main message from this page? What's the main conclusion that a member of this fund should draw? I'll just give you a few seconds to have a look at it. Okay, now if that felt like not enough time, that actually probably is one of my one of the conclusions that I'd like you to draw, because people are going to be making fairly quick snap judgments if they're a client. What is the main message? It needs to be able to jump off the page to me if it's going to have any impact. And in this case, there's quite a lot going on in this slide. So if you're sitting there going, actually, you know what, I didn't have enough time to work out what the main message is, perfect, because that's, I think, what the conclusion I would hope that you would draw from it is. But if we look at it in a bit more detail, we might say, well, actually, there's a few possibilities here. So one is we could say, well, maybe this is a compliance message. So maybe the message is that our actual allocations in this column here, so it's 45.7% to global equities, is within the permissible range. All right, this 24.9, that's within this range. So really, this is a compliance message saying, actually, you know what? We're within the ranges. That nothing untoward is going on here. Now, I'm not saying that that is necessarily the case, but that's one possibility. Now, if that was what we're trying to convey here, so now thinking about some of the psychology of how people actually make decisions, and this has nothing to do with emotions again. This is again around the mechanics of, well, simple things like how easy it is for me to make that comparison. So 45.7, for me to work out whether that's in the range, I have to, for a start, move my eyes 2 columns to the right. So that's making it harder. So I could have put this range next to it if I wanted that to be an easier comparison, but no, I have to go past the target to get to the range. Then I have to say, is 45.7 above this number? Yes, it is. Is it below this number? Yes, it is. Therefore, it's in the range. Good. Next, 24.9. Is it above this number? Yes. Is it below this number? Yes. In the range? Tick. Okay. How could we have made that easier? Well, we could have, as I said, put the range next to it. We could have said, put a green tick, for example, or a cross if there was a cross, for example, to say, yeah, it's each of these is within the range. We could have made that comparison a bit easier using relatively simple strategies. But then you might say, well, actually, it's not about compliance. I mean, this is about tactical asset allocation. This is about how much people have allocated in each category relative to the target. So really, it's about the fact that this 45.7 is above this 45.0, and we're making a tactical decision to put 0.7 more in global equities and a bit more in US equities and a bit less in non-US equities relative to these targets. Right? In this case, those 2 columns are next to each other, so it is a bit easier. However, I still have to go 45.7. Is that above or below this number? How much is it above or below this number? So I still have to do it. There's a little bit of calculating in there. It's not quite straightforward. I could possibly have made it easier by putting a plus 0.7 or a green plus 0.7 or a small up green arrow or something there to make that easier. So I could have possibly done a few things there. What else? Well, you know what? Actually, there's a pie chart down here, and you know what? A picture tells 1,000 words. So really, if I want to compare the actual with target, all I need to do is compare the actual allocation here with the target allocation over here. And what you can clearly see from this pie chart is that this blue segment here is 0.7 bigger than this blue segment here. Now, I don't know whether my sarcasm has come across on the webinar, but no, you cannot see that at all, right? That segment there is very, very difficult to distinguish from this segment over here. Those 2 pie charts are completely ineffective if what we're trying to use them for is to compare the actual and the target allocation. But then you might say, yes, but wait a minute, what about these columns down here? Can we use those? Doesn't this tell us here, this little tiny bar here, doesn't that show us that global equities is above target? And I would say, yes, it does. However, it's obscured by the fact that we've got this bigger box around it. So that amount there is very hard to tell how big it is. And it's also the order of these bars makes it hard. If I was to say to you, which is the biggest above target number, well, you'd have to run your eyes across and go, well, that looks like it's down. This is down, or there's a number down there, minus 2.1. Oh, that's it there and that one there. So we could again made it easier by putting them in order, by getting rid of these boxes. Anyway, there's a bunch of things we could have done. Anyway, you might say, well, actually, no, it's not about that at all. It's about strategic asset allocation. It's about how much do we have allocated generally to each of these categories. And we can see that from this target chart here, that most of it is global equities. And in that case, I would say, yeah, I agree that chart does show that. But here are some of those shortcuts again, like that diversification shortcut that I alluded to earlier. So what we know is that how people interpret diversification is by the size and evenness, or the number and evenness of the pie segments. So a client responding to this would say, that doesn't look that diversified because I have this big chunky blue segment here, or purple, or whatever it is, blue segment here, which takes up almost half of the allocation. Now, of course, what we know is this is global equities, and we could split it into US and non-US, which would break those two in sort of roughly half. And within that, we know there's actually probably thousands of individual investments in it. There's a hell of a lot of diversification going on, but the way it's presented obscures that diversification. And it also makes understanding the risk profile a bit difficult, because these things, again, are not in order. So we've got fixed income occurs before we get to multi-asset and global real estate, and opportunistic and tactical, for example. So they're not actually even in order of risk. And then you might say, well, actually, you know what? The main message here is that this is a decent sized fund. Look, it's got 14.5 billion. It's not really about how it's invested. This is a big, substantial fund, and members should feel comfortable. And if that's the case, I'd say, well, why do we need all these numbers up here? Is that number just there? Why do we need all these individual digits? Because they're not meaningful, and they provide spurious accuracy. There's, again, a bunch of things we could do. If that was the main message, we wouldn't be presenting it in this way. So sorry to burden you with 1,000 things that are wrong with that, but this is the sort of thing that quite often I see. There's a lot of examples here, but it's not that difficult to find these sorts of things on websites, in reports, for example, in the appendices of an SOA, in various sort of investment tools, for example. So let me just give you one final example before we can sort of turn to the multiple choice questions and Q&A. And this is a question I've given both clients and to advisors. So I'll give you the advisor version. So which manager would you choose? A client asks you to recommend one of two Australian equity managers, other than for differences in their performance. My page has gone behind the. You determine that each is equally appropriate for the client. Their performance relative to an Australian equities benchmark is shown below. If you had to recommend one and only one of these managers, would it be manager A or manager B? Now, before you say, oh, God, this is too hard, I need more information. So let's assume they've got the same style, they've got identically qualified teams, they've got what else? I don't know, they're both on your APL, they're both available through your platform, they've both got roughly the same sort of fees. Okay, so they're largely indistinguishable, but their returns are a little bit different. All right, so here's a table of their returns. Which of those two would you choose if you had to choose only one of those two managers? Now, while you're contemplating that, would it make any difference if I showed you this table? Now, what you might notice from those two tables is they're actually just identical, except I've changed the order. So these 5-year returns are now on the left-hand side. There's the 1.7, there's the 0.9, right? Then the 3 years have just been moved down to here, 1 years are in the middle. So all I've done is switch the order around. Now, would switching the order make any difference? Or sorry, should switching the order make any difference? Right, from a completely rational perspective, no, switching the order shouldn't make any difference. It's the same returns. I've just put the order in different, positioned them in a different order on the table. Does it make a difference? So this is an example where it does make a difference, but the difference is more for clients than it is for advisors. So having tested this with both clients and advisors, yeah, it does influence clients. I mean, not completely. It does influence them a bit. So you're probably going to get about a 10% bigger allocation to manager B in this case. When you've got the short-term returns on the left, people tend to look at the short-term returns. When you've got the long-term returns on the left, people tend to look at the long-term returns, right? So in this version, they're more likely to go with manager A. In this version, they're more likely to go with manager B. Now that distinction, as I said, is bigger when I've tested this with individual clients, and it's smaller when I've done it with advisors, but it still was a positive effect. It still influenced advisors a bit as well. So what's going on here? Again, this is relatively simple psychology. This isn't emotions. This isn't sort of sophisticated base rate pattern recognition errors. This is basically the very simple idea that we tend to read left to right. Okay, so this is the first thing we see on the left-hand side. We then, if we do scroll our eyes left to right, which we may or may not do. We start at the left. If we go right, we're going to see those things afterwards. And what happens, what we know is that the first thing that we see is going to influence how we interpret what comes afterwards. So we're going to be more influenced by this thing on the left. So the strategy here is, if we think that the longer term returns are most relevant for clients, which I'm not saying is always the case, but if that's what we think, then we should be putting those things on the left. And certainly some super funds are now doing this. The Future Fund does this. Alan Gray, an asset manager, does this. I'm pretty sure Morningstar does it this way as well. So progressively, I think as an industry, we are moving in this direction. But the broad principle is, let's put the things first that we think are most important. Okay, so just briefly in recap then. So we've seen a bunch of principles. We looked at the regulatory reforms, but then looking at some of those sort of strategies. And what can we do? We can put those things in documents and reports. So I think there's a bunch of things we can put in SOAs. Possibly we need to be changing templates. Investment reports, perhaps our easier sort of ongoing client engagement materials. Emails, we can definitely be putting things in titles. We can be removing content and replacing it with links, for example. There's a bunch of things we can do there. Websites, that's often where you see these charts and tables and things. Again, there's quite a few things to embed in there that can change the way clients interpret and respond to different information. Are they likely to overreact to short-term returns? Well, they are if we put it on the left-hand side, or depending on what chart we've got. PowerPoint presentations, how can we put things in headings, limit the number of bullet points? For example, how do we display charts, the call out buttons that we use? Each of those things is going to change how people respond. Fact-find questionnaires and risk profiling tools. Again, this goes to the types of questions, how people interpret them, how people understand them. Can they predict their own behavior? Are they influenced by motivated reasoning about wanting to think that they're a good person? Are they influenced by how they remember things in the past, for example, hindsight bias? And again, client conversation. This has mostly been about written forms of communication, but similar, we can use some of the same sorts of principles in actually verbal client conversations as well. So we're going to go to, I was going to say, feel free to reach out to me, anyone who wants to have a chat about this in further detail. I've got a book and some courses as well. But I think on that note, we will go to to the multiple choice questions, which are now appearing on the screen. Okay, so I think what I'm going to do is read each of these things out, and then we'll see what everyone's responses are, and I'll have a bit of a quick chat through how well everyone's done. So good luck, everybody. All right, so question 1. FASEA included behavioural finance related questions in the advisor exam, or FASEA included behavioural finance related subjects in the advisor education requirements, or FASEA included behavioural finance related insights in the advisor code of ethics, or all of the above.
And then we'll move on to question 2 and we'll pull up all the answers together. Simon?
Okay, sounds good. So I'm scrolling mine now. I'm not sure if is that scrolling everybody's?
Yeah, everyone needs to scroll down to
everyone needs to scroll. Okay. All right, cool. Assuming everyone's done number 1, let's move on to number 2. An advisor wants to encourage a client to address their estate planning needs. The advisor tells the client that many other people have also not yet addressed this issue. Behavioral research suggests this statement will probably make the client more likely to address their estate planning needs, less likely to address their estate planning needs, neither more or less likely to address their estate planning needs. Is it useful? Is it useful for the advisor to tell the client that many other people have also not yet addressed this issue? Or make them more likely to address the issues, less likely, or neither?
And then we'll move
moving
on to
question 3. Yep, question 3. When preparing client-facing materials such as investment reports, statements of advice, PowerPoint presentations, and emails to help clients make decisions, advisors should A, incorporate as much information as possible because clients can always ignore anything that is not relevant. Or advisors should not worry too much about the order information is presented because clients can always search for what is most important. Or they should show amounts in individual dollars because numbers that are rounded to thousands are less accurate. Or none of the above.
Now, I do encourage everyone to complete. We can see that not that many people have yet answered. So to get your CPD, you do need to complete the quiz. So give it a go. There's only 3 questions there, and we'll give you another 30 seconds to complete, and then we'll bring up the responses.
I presume that in good psychological experiment sort of traditions, anyone who gets the wrong answer will be administered an electric shock. Silvana, is that how it works?
And that's exactly how it's going to work. Yes. So
awesome.
We're going to go with the stick, not the carrot. That's right.
Sounds good.
So we'll just give you, okay, that's great. We've now got many more people have responded. We've just got a few more. I would say just give it your best shot, because in Simon talking about the responses will be another learning opportunity. So I'll give you another 5 seconds, and then Dean will bring up the responses. We've just had a comment, Simon, saying great session. Okay, bring up the responses, and here we go.
All right, so FASEA included behavioural finance related questions in the advisor exam. That is true, it did. I know that because I wrote several hundred of them. So that is definitely true. Did FASEA included behavioural finance related subjects in the advisor education requirements? Yes, they did. They were the bridging, they included the bridging unit subjects around behavioural finance. Not always called behavioural finance, but sometimes called things like client engagement and decision making or something. They're different names, but sort of broadly around the same topic. Behavioural finance related insights in the advisor code of ethics. Yeah, again, they're definitely in there. Again, not labeled as this is about behavioural finance, but they do pick up things like that point about the disclosure not being sufficient. You now need to not just tell your client stuff, you need to take reasonable steps to make sure that they understand. So going beyond the sort of purely rational. So well done for the 80% who said all of the above, and for everybody else, you've got right answers. It's just there were more right answers, I guess, on the page. Number 2, an advisor wants to encourage their clients to address their estate planning needs. The advisor tells a client that many other people have also not yet addressed this issue. So this is going to that social influence thing again, a bit like the telling people that other people have littered in this area, or telling people that other people use a lot of energy, telling people that other people haven't done their insurance. Anytime that we tell them what other people are doing, they're going to be influenced. Not everybody, not all of the time, but on average, that tends to be what tends to happen. So is it going to make them more likely to address their estate planning needs? Not that sentence. So hopefully the conversation the advisor has afterwards about the need for estate planning, that bit, hopefully yes. This bit about telling what other people do, no, unfortunately, it's actually then going to influence them. As I say, not everybody, but it tends to influence people to do the same as other people. So less likely to do their estate planning needs is correct, and neither more or less likely to address their estate planning needs. Well, I have some sympathy for people who answered that one, because we don't really know about a particular client, what will or will not influence them. But certainly on average, we've got a wealth of information about what tends to influence people in most cases. And so without knowing anything more, I would say, yes, it's less likely to address their estate planning needs. And certainly I'd reverse it and say, a lot of my clients are saying they don't want to end up with leaving their partner with a giant mortgage or something. Well, anyway, that's probably insurance rather than estate planning, but trying to find some way to influence them positively. Okay, last one. When preparing client-facing materials such as investment reports, statement of advice, PowerPoint presentations, and emails to help clients make decisions, advisors should incorporate as much information as possible, because clients can always ignore anything that is not relevant. This is sort of what a compliance sort of view of the world would be. And I, again, have some sympathy. You have to do a whole lot of stuff just simply for legal reasons or compliance reasons. You have to give them this information. But from a psychological perspective, giving them lots of information isn't the best approach. What we need to give them is the relevant information, highlight what's most important for them, that sort of stuff, because otherwise there's a big risk that they just ignore the information that we provide them. Anyway, that's obviously a big challenge for the industry. But from a psychological perspective, it's not that more is not better. Not to worry too much about the order information is presented, because clients can always search for what is most important. Yes, they can always search for what is most important. So that's sort of a bit of a trick question. But what we know is that if we put the most important things first, they're most likely to see it, and they're most likely to be influenced by it. So that's one thing we can do, is to help by making sure the most important thing isn't on page 17 of our report where people aren't going to see it. It's actually front and center. It's on the front page. It's in the heading, depending on the type of engagement. We should show amounts in individual dollars, because numbers that are around the thousands are less accurate. It's completely right that they're less accurate. But unfortunately, well, the reason I put this one here is that the showing numbers to individual dollars presents, in the case like what we saw before, spurious accuracy, showing that you've got 14 billion or whatever dollars in your fund. Well, as soon as the market opens, that number is going to be different. The main point is it's 14.5 billion, not that the last dollar is 6. And so well done to the 72% who said none of the above in that case. But yeah, a couple of little tricks in there for those. Apologies for those I've thrown off the scent.
Now, unfortunately, we actually don't have time for questions because we've hit 2 o'clock, and we always keep to time because we know people have got other appointments. Though I've got a very quick one. Will you be doing a submission to the quality of advice review, Simon? Because obviously this stuff is hugely relevant to that review.
I think I might have missed my chance. When's it due? Is it due today or
It
yesterday?
was due last Friday.
Yeah.
But even so, it might be worthwhile or trying to sort of see if you could, get something in. Anyway, I am going to have to close because we've hit the 2 o'clock. So on behalf of Stockbrokers and Investment Advisors Association, I'd like to thank you very much, Simon. That was a really insightful presentation. I was taking notes. I thought that was fantastic. We're going to follow up, everyone, with links to the presentation and recording, as well as an email confirming your CIA accredited CPD. And as you leave, there will be an opportunity to complete an evaluation. Please do complete it. It will take just a few seconds. It really helps us in terms of putting together our webinars for you, for your CPD. So for now, I'll say good afternoon, complete the evaluation on your way out. And Simon, thank you once again. That was fantastic. Really appreciate it.
Thanks for having me. Thanks, everybody.
Okay, thanks, everyone. Bye now.